Hey guys, and welcome to today's video. So by the end of today's video, you're going to understand the ICT Fair Value Gap and how to use it to create a profitable trading strategy. So without further ado, let's get right into it. So you can see right here on the screen, what we have right here is the bearish and the bullish fair value gap. So on the left side of the screen right here is the bearish fair value gap, and on the right side of the screen right here is the bullish fair value gap. So you can see the way price traded with momentums to the sell side, but by at the close of this particular candle, we saw price traded lower, and opening of this candle, price traded lower. But before price traded lower on this candle, price traded higher. But this um points of stretch of this particular candle, which is this week created, did not get to fill in this particular void right here. So this high didn't get to this particular high right here, so we had a void right here, remaining price, and this void is known as imbalance. Good. So creating what we now know as the bearish fair value gap. So price is going to look to come back later on in time to fill in this particular area in price and see price move down lower. Same thing can be said for the bullish fair value gap. You can see the momentum all the way to the buy side. We had this imbalance right here, so price created this high right here before this particular momentum right here, and at the opening of this candle, price pushed all aggressively to based on momentum to the buy side. But before it did that, you can see that it's at a point in time where saw price actually came downwards, but that's all bearish momentum never got to fill this particular void right here, creating this particular imbalance in price to the buy side. You know what I'm trying to say? So what happened is what's going to happen going forward in future is that later on in time, price is going to come down right here to fill in this particular sell side inefficiency and see price move to the buy side. You know what I'm saying? So without further ado, let's mark out those areas so that you can see it clearly now based on a pictorial format. You can see that from this high to this particular low, this particular space in price where we see that the wick did not meet, this particular area is considered as the fair value gap. Same thing can be said for the bullish side, for where this high and this where this low and this high did not meet, this particular space right here where we have this particular imbalance is known as the bullish fair value gap. So later I want to see price come into that particular area. So another thing again that is worthy of note is that this particular area is also known as the CB, and this particular area is known as the BC. Now CB stands for sell side imbalance and buy side inefficiency. So we saw a sell side imbalance, so price move aggressive to the sell side, creating an imbalance in price, which is now known regarded as a fair value gap. And now that fair value gap becomes a buy side inefficiency. Price going to come back into that particular area for buy side inefficiency to see price move downwards. Same thing can be said for the BC. Price moved aggressively to the buy side, creating what is known as the buy side imbalance. So later on in time, price is going to be coming down aggressively, or later on in time, or a particular Q zone to this particular sell side inefficiency to see price push higher aggressively. So without further ado, let's see some examples to drive this home and also frame our strategies correctly. So you're going to be learning the strategy moving forward from these particular examples. So let's say we have this particular piece of price action playing out in time, you want to say, and we're about to enter the London Q zone. So the pair we're using for this particular example is the GBP USD, and we're focused on the 15 minutes. So we are looking at this particular piece of price action, and price has done all of this. So what are you waiting for? You're waiting for us to get into a Q zone. Time and price is the bedrock of the ICT concept. Time and price is the bedrock of what? The ICT concept. So you want to wait for Q zones, you want to say, or for the silver bullet time stamps. Good. So we are at this particular Q zone, which is the London Q zone. What are you looking for this part? In this particular Q zone, you are looking for a raid on liquidity. You want to see a liquidity run. Why? Because the smart money, once you understand time and price, the next thing you want to understand more in the ICT concept is a run on liquidity. If there's no run on liquidity in the market, then there is no movement, you understand? So you want to wait for a run on liquidity, and that's what we have right here, and that's what we waited for. So we got a run on liquidity. Now after this run on liquidity, the next thing we're looking out for, we want to see a displacement in price. So right here now we have that particular displacement in price. And now what is the essence of this particular displacement in price? You can see that when we had this displacement in price, it created what is here a fair value gap. Now this is the bearish fair value gap, just like we learned from the examples from the previous slides. You understand? So we have this particular bearish fair value gap right here. So all we want to see is how price come into this particular fair value gap and react, and that's going to give us our entry and probably help us frame our risk to reward. So we mark that out in time from this particular low to this particular high, and this is known as the CB, which is sell side imbalance, buy side inefficiency. So price is going to come to this particular area into the buy side, which is the buy side inefficiency, to see price go lower. Good. So we watch the price and we saw price do this. So price came into this particular area, just clearing above this particular high. Mind you, price can actually get to the main threshold of this particular area or even fill this particular void completely. You understand? Because this whole imbalance right here, the range of this whole imbalance right here, this sell side imbalance is the playground for price. And then gets now to see price go lower. So don't be too stereotyped to always see this particular reaction in price. Price can actually drive in deeper. You understand? So but let's follow the example through. So we see how price reacted, just sweeping above this particular region right here and give us a reaction in price to the sell side. You can see this particular sell side candle right here confirming the momentum is now shifted to the sell side after driving into this particular buy side inefficiency. Good. So now we have our entry. We can take our entry right there and we can put our stop loss just above this particular fair value gap, because we don't want to see price come and move into his playground and weak us out. You get, and mind you, this is a London Q zone. Sometimes the London Q zone can be very tricky for manipulation, so you want to be very careful. That's just one nugget I feel like should chip into this particular video. Good. So we have our entry right here, framing our risks at that particular area. Then price spraying out is going to be our reward, giving us a one-to-one risks to reward. So this is how you can be able to profit using the ICT fair value gap, and this is the simple process of this particular strategy for a sell program in price. So moving forward, you can also even reframe your risk to reward just above the reaction in price and get a better risk to reward. So that will be depending on you and how well you've mastered this particular strategy. So let's just keep moving on to see how well we can actually benefit using this particular strategy on a buy program. So moving forward right here, let's say we saw this particular piece of price action printing out in price and we're about to enter the New York Q zone. Like I've established earlier, time and price are the bedrock of the ICT concept. Good. So we want to see price moving into a particular Q zone, and we're waiting for what price is going to do within that particular Q zone, and that was going to strengthen our ideas and convictions in taking any particular setup or reactions in price that we see. So the first thing we're waiting for in this particular strategy is that I want to see a run on liquidity, and that's what we have right here. Good. Now we've had a run on liquidity. The next thing we're waiting for is the displacement in price. Now you can see the moment price draw into this particular liquidity, taking out this particular low, you can see the way price displaced all the way to the buy side. Now this displacement in price is very important because that is what creates the fair value gap. So you can see right here, you can see this particular fair value gap created right here. So we're going to mark that out in time. You can see the way this this loading gets to this particular high right here. So creating a BC, a buy side imbalance and a sell side inefficiency. So all we're waiting for is price to come into this particular sell side inefficiency. I want to see how price is going to keep reacting all the way to the buy side. So since we are privy to this particular price action right here, so our area of target is going to be this equal highs right here, or this ultimate high right here. And now some of you may be wondering why this ultimate high, because from this high to this particular low is our trading range. This is the particular range we are still trading within right here. So if price defile this particular high and there's still much momentum in price, and we can see that, we can hold on to see if price is going to want to reach for this particular high. So moving forward, we can see the way price reacts into this particular area, into this particular sell side inefficiency. And you can see some of you may be worried why the candle was printing, because of the momentum at the point is going to be super going against you right here. Good. So what you want to wait for is for the candle to close, and if the bodies of the candle close above this down close line, this particular line drawn here, which is this particular high for a buy program using the fair value gap, then you can be rest assured that your fair value gap area is confirmed. You want to say to continue your buy program. Same can also be said or applied for a sell program. You get it now. So you can see the way the bodies of this particular candle closed above, even above this first area of reaction right here. So that confirms okay that we have a buy signal. But if that is not enough for you, you can wait for a bullish confirmation also, which is what we also have right here. Good. So the L becomes our entry right there. So we frame our risks right there. Our risks are putting our stops below this particular low, because this is a closer area. We can actually even put it right here, but this particular area is more preferable, saying that we can frame a better risk to reward from this zone to this particular area right here. So let's see how price played out. Good. Boom. So we can see we can take out portions right here, which we did while we're trading this particular system live. So the next thing area we want to take out will be right here. So you can see the way the whole momentum pushed aggressive to the buy side. So this particular area, you can see the way price came down, retested above that particular zone right there, also into a fair value gap, and you can see how price thrived aggressively into this particular high, which is the end point of this entire trading range right here to the left side of the chart. So this is how you can actually use the ICT fair value gap, applying time and price concept to better engage and profit from the forex financial market. So if you found value in today's video, hit the like button, hit the subscribe button, and see you in future videos.